Welcome to Credit Data Point. My name is Brian, and today we're looking at the credit score black box. Until about 5 years ago, I had no idea how my credit score worked. I just assumed that, if my credit score was good, I would get approved for things, but I didn't really understand how it worked, and it was just kind of a mystery box to me. Some of you might feel that way too. Once I started researching exactly what your credit score consists of, I was surprised at what I found. I talked to many others about what I discovered, and most people didn't really know either. Maybe you're one of those, and maybe you already know a lot about it. In any case, we're going to take a deep dive into your credit score. First off, your credit score is maintained by 3 credit bureaus. Those are Experian, Equifax, and TransUnion. Each one of them, in theory, gets a copy of each of your credit decisions, your payment history, things like that, all are reported to those credit bureaus. Sometimes the reports aren't the same, sometimes they're very similar. Your credit scores often differ slightly between them as well. Now, your credit score itself ranges from 300 to 850. 850 is considered quote-unquote a perfect score, but don't worry about that because it's quite difficult to actually have an 850 and keep it that way unless you do nothing at all with credit. Another thing, there isn't just a single score. There are multiple credit scores. The one most people are accustomed to hearing is your FICO score. This is the one that almost all banks and lenders use to decide whether or not you're creditworthy enough to be approved for a loan or credit card or whatever else that involves credit, such as a mortgage also. Now, even within FICO scores, there's quite a few different versions. The current version that's used most often by the majority of banks seems to be the FICO 8 score, but there are also newer FICO 9 and now FICO 10 scores. Some banks are switching to FICO 9. I'm not aware of any using FICO 10 yet, but they will eventually. You may have heard of other types of credit scores, such as your Vantage score, 3.0 for example. This is what some people call FICO scores, in the sense that they are calculated using a different model and often vary significantly from what your actual FICO score is. Even within your FICO score, there are different versions of the FICO score, besides just the 8, 9, and 10, and so forth. So within FICO scores, you have FICO bank card scores, FICO auto scores, and just, plain FICO scores. Different banks use different versions based on what they're looking to approve you for. Some use the FICO auto score if you're applying for a car loan. Others use FICO score 2, for example, which is often used for mortgages. If we're talking about credit scores, it's also important to talk about credit inquiries. These are often called hard pulls and soft pulls. A credit pull is when a bank or lender requests a copy of your credit report. Now, a soft pull does not leave any evidence of that inquiry on your credit report. Banks will often soft pull your credit report once you're a customer in order to offer you new credit cards or new loan products, things like that. A hard credit inquiry or a hard pull is where a bank requests a copy of your credit report in order to provide you with a credit product and approve you for that, hopefully. Where with soft inquiries, they do not show up on your credit report. Hard inquiries do. Hard inquiries stay on your credit report for 24 months and factor into your FICO score for 12 months. Now, when it comes to FICO scores, obviously, the fewer hard inquiries you have, the better. But don't be afraid of having any hard inquiries at all, but it's maybe difficult to get approved for any credit products if you have a whole bunch of credit inquiries, because that looks like credit-seeking behavior, as the banks call it, and makes you look like a more risky person to lend to. What really becomes important with your credit score is the components that make it up. Number 1 is your payment history, and that makes up 35% of your credit score. That's the largest single component to your credit score. And payment history literally means your history of on-time or not on-time payments. Essentially, anything but 100% perfect does ding you significantly in this area. Don't worry if you accidentally miss a payment for some reason, and we've all done it, especially if you have a lot of credit cards. It's difficult not to make that mistake at least once. First thing to do is call up the bank and see if they will waive any fees and tell them what happened and that you will not make that mistake again. Often banks will then just reverse the fees, and as long as this isn't a frequent occurrence, you can go on your way. If you miss a payment and you don't deal with it for a whole month, then that will be reported to your credit report. So don't worry if you miss a payment or you're a little bit late. It will not immediately report, but if you wait long enough, it will report to your credit report. Of course, that's not good for your credit score and will have a significant impact. The second part of your credit score is credit utilization. This is quite literally how much of your available credit you're using. And part of the metrics that go into this are both your individual credit card utilization. Let's say you have a card with a $10,000 credit limit and you're using $2,000. That would be a 20% credit utilization, as well as your cumulative utilization. If you have $50,000 of available credit on credit cards and you're using 20,000 of that, then that would be a 40% credit utilization overall. Those both factor into this section. This is actually the section that's the easiest to improve in the shortest amount of time, but we'll get back to that in a minute. The third component of your credit score, which makes up 15% of your score, is length of credit history. This is quite literally the length you've had credit. It factors in both your age of your oldest account as well as your average age of accounts. Now, your average age of accounts is what has the greatest impact on your credit score itself. This is quite literally how long you've had each credit card divided by the total number of credit cards. And every time you apply for a new card, it drops your average age of accounts. However, if you have a solid base of cards, like let's say 5 no annual fee credit cards that you plan on keeping open forever, when you apply for a new card, the average age of accounts does not change all that much. Now, if you only have a single account and apply for a new one, your average age of accounts drops in half. The fourth component of your credit score is new credit, and this makes up 10% of your score. This is where inquiries have an effect, how many new accounts have been opened recently, and that type of thing. The final component of your credit score is credit mix, and this is made up of what different types of credit you have: credit cards, auto loans, unsecured loans of other types, mortgages, anything along those lines. You get a better score in this area by having multiple different types of credit. I caution you in particular on this area. I would essentially ignore this credit mix section. It's not important in your credit score. Having credit cards that report to your credit report that are paid off and you're not paying interest on and have low utilization is far more important than having a mix of different credit. Don't go out and get a car loan just so you have something else to add to your credit report. Circling back to look at the most important areas of your credit score, don't worry about new credit, which is only 10%. Don't worry about credit mix, which is also 10%. Length of credit history, there isn't much you can do about that except wait it out as you gain new items on your credit report, so that's not too much of a concern. It's only 15% as well. The two areas to focus on are payment history and also credit utilization. The number one thing you can do right now is make sure you pay all your credit bills on time. Don't miss any payments. At least make the minimum payment, even though that may mean you're paying interest, which you should not be paying because it's absolutely blows away any credit card rewards or anything like that you might get. The interest is very, very high on all credit cards. But in any case, in order to keep this area in the good standing, just make your minimum payment on all credit cards. The area that you can really make a difference in is credit utilization. If you, let's say, have a credit card that has a $10,000 credit limit and you charge your normal monthly expenses to it every month, and let's say it's $4,000. So that would be a 40% credit utilization when your statement closes and it's reported to the credit report. Rather than waiting until after your statement closes, pay the bill just before the statement closes. So if you know you've charged about $4,000, make a $3,500 or $4,000 payment several days before the statement closes, so the statement closes with a much lower balance. Then continue on using your card as normal. Now, if you're carrying a balance and paying interest, this doesn't work as well, but that's not a good idea with credit cards at all. And credit card interest can be a real trap that I don't want any of you to fall into. It's not very much fun because the costs quickly get out of hand. If you want to understand the specifics about how your credit score works in more detail, go to creditdatapoint.com and click on the Credit Score Black Box article. That will explain everything I've mentioned in this video in more detail and help you get a better credit score quickly. Back to the things that impact your credit score. If you're starting out on your credit journey, I would suggest you get a no annual fee credit card from probably the bank that you are already banking with. If you're banking with, let's say, Bank of America or Chase and you have an established relationship, they're more likely to approve you than a bank you've never dealt with before. Focus on something that is a simple card with no annual fee that you plan on keeping forever. Then I would suggest you build up at least 6 months of on-time payment history and low utilization with that card, then maybe add another card after that. You may need to wait a year if you want to use Chase credit cards, for example. They often require that you have another credit card for at least a year before they'll approve you for any cards. Also, watch out for rules like the Chase 524 rule. This rule means that if you have 5 credit cards or more that report on your personal credit report within the last 24 months, Chase will automatically decline you for the vast majority of their cards. So it is a good idea to possibly start with Chase if you're interested in any of their credit cards, and then move on to other issuers after that. In any case, even if your credit score isn't going so well and you may have dropped down into the 600s or even in the 500s, don't lose hope. Follow these simple steps. Make sure you start paying everything on time. Drop your credit utilization as much as possible. And in time, your credit score will improve. Once you do reach a better credit score, you want to target at least a 720, because a 720 or better gets you the best interest rates. If you're maintaining a score in the mid 700s, that's excellent. Anything higher than that doesn't really make a difference. You can get a better credit score. You can get an 850 credit score by having no recent credit activity for several years, essentially zero utilization, and have, I believe it's more than 20 credit lines reporting to actually get an 850 credit score. It's really not something that's important or a good goal to have. Having a mid to high 700s is perfectly adequate for anything that you want to do with credit. Again, go to creditdatapoint.com for more information on this video and lots of other content.